All eyes today on April Eurozone inflation and Eurozone PMIs. We also get some other PMIs coming out later in the afternoon as well as on Monday, especially for the April month, which is just ended. While in the US, the April jobs report could be the next metric, shedding clues on the US tariff-driven slowdown. And we get Q1 earnings from Exxon also released later today. Wall Street was upbeat as Microsoft and Meta earnings fueled the big tech trade as the debate continues on the fallout from the record hit to United States GDP from trade in the first quarter. Still yesterday saw the Nasdaq leading US stocks higher as corporate earnings eased fears. Indeed, big tech has completely reversed its April tariff sell-off and boosting confidence in Wall Street as some had predicted will happen. Also, after the bell, both Apple and Amazon earnings released their results, beating expectations. Apple topped its latest quarter earnings estimates on strong iPhone sales, but missed revenue expectations for its Greater China segment as the trade war between the world's two largest economies intensifies. While for Amazon, the underperformance of Amazon Web Services revenue and the impact of tariffs also got attention. On the earnings call, Amazon CEO Andy Jassy said it has yet to see any significant impact from tariffs in the areas of demand and sellers setting product pricing, though he admitted that could change later, but profits would be impacted. Nigeria's private sector business activity maintained positive momentum into the start of the second quarter of the year as the PMI just out this morning settled at 54.2. That's for April, broadly in line with 54.3 recorded in March. Improvement in business activity was primarily due to improved customer demand amid softening inflationary pressures supporting new orders. All four monitored sectors posted an improvement, with the most significant in services. Stanbic IBTC Research in their latest PMI report say they expect trends to be maintained, albeit relatively slower than witnessed in Q1 2025 as the local currency is expected to depreciate in Q2 compared to Q1 amid the lingering global uncertainties, and that could lead to slightly higher inflation rate than seen in the first quarter, but overall expecting the Nigerian economy to grow by 3.5% year on year in 2025 relative to 3.4% year on year in 2024. Hello and welcome to Global Business Insights, where we look closer at headlines moving markets to equip viewers with perspectives to help them thrive in today's business environment, where we are seeing very different factors at play. Let's go into our deep dive first, and that's looking at both Apple and Amazon and some of the other results. For Apple, sales in China, where most of its iPhones are produced, fell more than anticipated in the latest quarter, overshadowing otherwise decent results. Apple said they did not see any pull forward due to tariffs, and also for Apple, the closely watched services division came up lighter in terms of estimates. So it's not all great. Still, Apple earnings per share at $1.65 beat $1.63 expected. Revenue was $95.36 billion, also beating $94.66 billion expected. Gross margin at 41.7% was, however, much lower than 47.1% expected, suggesting expenses are also up more than expected. Apple's most important product line, the iPhone, topped estimates at $46.8 billion in sales. That's dollars during the quarter, with sales just up just under 2% on an annual basis. Mac revenue at $7.95 billion was better than $7.77 billion expected. iPad also did better than expected at revenue of $6.4 billion. Apple Services Division, which includes iCloud subscriptions, services like Apple Music and Apple TV Plus, and warranties and revenue from search licensing deals, saw double-digit growth to $26.65 billion in revenue during the quarter, an annual increase of 11.65%. However, services revenue came in slightly under expectations. Last year, Apple Services division actually grew 14.2% during the March quarter. Other products that underperformed targets include wearables and accessories with revenue of $7.52 billion, less than $7.95 billion expected. Sales in Greater China, like we said, which includes Taiwan and Hong Kong, were down slightly year over year at $16 billion. But sales in the Americas, that's Apple's largest market, rose nearly 8%. In opening the investor call, Cook spoke on manufacturing plans in the US, reminding investors of announced plans to spend $500 billion over the next 4 years. Expansion can be expected in Michigan, Texas, California, Arizona, Nevada, Iowa, Oregon, North Carolina, and Washington, with a new factory for advanced server manufacturing that's in Texas. On guidance, Apple said it expects the June quarter revenue to grow low to middle single digits from last year, also in line with previous estimates, so no downward revisions there. He also reiterated that demand for products with AI is stronger than those without. In terms of the geographic print on sales, Apple is moving to other developing economies to compensate for challenges in China. These include a push into Brazil, Turkey, Poland, India, and the Philippines, with new retail stores in the United Arab Emirates and India, and then there's the new online Apple store also in Saudi Arabia. The elephant in the room was the impact of tariffs, and Cook said there was limited impact from tariffs as Apple was able to optimize the supply chain and inventory as required. That was in the March quarter, but still in the June quarter, they estimate, assuming everything is unchanged from where we are, could be a $900 million impact, though it still sees a lot unclear in terms of how tariffs will eventually settle. Also on tariffs, he clarified that a majority of the Apple iPhones in the third quarter will come from India, which currently faces no tariffs on smartphones, while the rest will come from China at what is currently a 20% tax rate. Apple Watch and AirPods come from Vietnam at a 10% rate, but there are some accessories that will face a stiff China 145% levy. Amazon in the March quarter reported earnings per share of $1.59 compared with consensus estimates of $1.37, with revenue at $155.7 billion, also above analysts' estimates of $155.2 billion. Amazon gave a revenue guidance for the current quarter of $159 to $164 billion at the midpoint of the range, still roughly in line with the consensus of $161.2 billion. Amazon Web Services revenue, however, was slightly disappointing, with sales at $29.3 billion when you compare that with the $29.4 billion that was estimated. It, however, also gave that Amazon a weaker than expected forecast for operating profit in the current quarter, also pointing towards tariffs and trade policies that may cause consumers to pull back on spending. But there were other earnings results for major bellwether companies. McDonald's reported first quarter earnings that missed expectations as a drop in sales and traffic in the US weighed on results at the fast food giant. Q1 revenue was $5.95 billion, below the $6.12 billion expected, also a 3% decline from the prior year period. Sales at restaurants in operation for more than a year fell 1%, led by a 3.6% drop in US same-store sales as fewer customers visited McDonald's. We can summarize by concluding that while the AI-driven and providers of tech efficiency levers like cloud computing are much more tariff-proof, indeed the higher cost profiles due to tariffs may actually incentivize faster assimilation of some of these new technologies that help to save costs and accelerate growth more efficiently. But pure consumer plays like consumer electronics and snacks business may not be as tariff proof. We could see a rotation from consumer-oriented technology to AI cloud leaders. That's a rotation in terms of where people want to put their on the stock market, where they want to be investing. US futures after Amazon and Apple announcement was not as positive as, say, Microsoft stock, which got the biggest earnings boost since 2015. More business news, especially PMIs that are just coming out. In the UK, according to latest April PMI data, which showed manufacturers facing a tough operating backdrop with market uncertainties rising, client confidence retreating, and cost pressures also intensifying. At 45.4 in April, that's the PMI manufacturing index. It remained in contraction for the 7th straight month. Manufacturing production contracted to a slightly lesser extent than what we had in March, as output was scaled back in response to reduced intakes of new work from both domestic and overseas markets. Panelists surveyed also reported that rising economic and trade uncertainties are resulting in an increased reluctance to commit to new contracts. In the US, S&P Global US Manufacturing PMI recorded 50.2 in April, unchanged since March. Although in expansion, the index again signaled only a marginal expansion. More data. Germany factory April PMI just out, where production levels rose at the quickest rate for more than 3 years in April, supported by an upturn in export orders. Headline: Hamburg Commercial Bank Germany Manufacturing PMI, that's a gauge of overall business conditions, was 48.4 in April, up slightly from March's 48.3. The latest reading was the highest recorded for more than 2.5 years, which principally owed to a solid and accelerated increase in output. Eurozone factory PMI also out this morning, 49.0, higher than 48.6 in March, also a 32-month high. Australia's retail sales rose 0.3% month-on-month in March, compared to an increase of 0.2% in February and below expectations of 0.4%. We also got some company news. British oil giant Shell today reported stronger than expected first quarter profit and kept the pace of its share buyback program, though earnings last year in the same quarter were around 28% higher. Shell Q1 earnings of $5.58 billion beat $5.09 billion expected. Shell also announced another $3.5 billion share buyback program, which it expects to complete over the next 3 months. Standard Chartered also reported Q1 earnings that beat expectations on strong growth in its wealth management business. Profit before tax for Q1 ended, that was March quarter, $2.1 billion, up from $1.9 billion in the same period a year ago. Asia Pacific markets closed mostly higher. This was as China said it is evaluating US efforts to initiate trade negotiations, potentially paving the way for the world's 2 largest economies to start talks to resolve a trade war that has rattled financial markets and cast a cloud on global economic outlook. The markets in the region also trailed gains on Wall Street after all 3 key benchmarks advanced overnight on optimism that a global slowdown will not materially stall artificial intelligence deployments and new technology assimilation. Well, that's all on this edition of Global Business Insights. Thanks for watching. Bye-bye.